All right, we're live. Let me just make sure everybody can see my screen and that I'm not muted because I do that a lot. All right, so you guys in the Discord can hear me. I'm live on YouTube. I'm live on Twitch. We're live. All right, so there's a couple things. First off, can you guys in the Discord see my screen okay? It's not pixelated at the top. Sometimes we run into that issue with Discord. Okay, thank you, Gambler Man. Appreciate it. All right, let's go ahead and dig in. So a couple things I want to cover today is across these 4 topics here. So obviously, as you guys who are in the Discord already know, psychology is like 90% of all this stuff. So no plan in the world, no analysis in the world, no strategy is going to help you if you can't overcome certain obstacles that are just kind of built into us as humans. So identifying those, if you're stuck in a room with a demon, you call its name out, it's going to get scared of you. So we got to put names on things and label them and understand what causes them and how they, how they impact us. So things like FOMO, fear of missing out, greed, boredom, discomfort, external factors. If you're arguing with your kids or something and trying to make rational decisions, you're going to have a bad time with your impulse control, for example. So just understanding the impact of psychology is always going to be the top priority. Scuba Steve. What's going on, Appian? Glad you guys are here. And then beyond that, like once we get the psychology stuff ironed out, and that's usually where I think most people spend the first year or two. And that's usually what causes 90% of traders to wash out because they kind of tackle it from the wrong angle, if that makes sense. So rather than, gambling in the market and trying to, make things work and all that good stuff, I'd rather you guys treat this like a savings account. And that's kind of how you build long-term financial success is by not gambling, identifying your risks, controlling them, not guessing, right? You do think like, you guys, we all kind of start at the same place. We all just kind of want to make a lot of money. We want to make it really fast. And, we take unhealthy risks to get there a lot of times. And, just rest assured that the guys on Wall Street and the institutions, they're not doing that. They've got a clean system. It's mechanical. They follow it to the T every single day or they get fired. But we don't have the same kind of self-accountability because there's no one here at our house usually to hold us to that standard. We don't have the crushing weight of a firm that trades millions of dollars every day. So we have to kind of find a way to hold ourselves accountable and keep ourselves on track. And that's what keeps us out of the gambling territory and, all that good stuff. So the way we can do that is we can build we can build a trading plan with specific steps, right? And that's kind of what you need is, I don't want anyone to walk away from this with just a general concept of what they think they should do. I want everyone to be able to pull out specifics here. So for each of these 3 categories, portfolio management, position management, and technical analysis, I'm going to teach you guys some pretty easy strategies. And then you guys can kind of plug and play what you like and what you don't like. But ultimately, I want everyone to walk away with something specific. And I want you guys to be able to have confidence in it and not just blindly follow something someone else on the internet is saying. So that, that doesn't help you guys. So don't do what I do. Do what makes sense to you, right? Okay, and then you can ignore all this stuff. This is just some math stuff. It kind of helps you guys understand kind of why things make sense and why I prefer them personally. So let's dig into some psychology first. I'm going to try to keep this stream a little bit shorter and a little bit more on task because I know I get ramped up pretty quick and a lot of stuff gets blown over. So psychology is, again, we're just going to revisit this. It's the number one thing that we can ever focus on in the market. 90% of traders wash out within their first year or two before they get a good grasp of that psychology and they don't understand why. Yeah, we're just starting. So no rush. Happy Labor Day to you. The reason people get washed out of the market is because they don't know what they don't know and they don't know how to control things that are controlling them. Okay, so we're humans by default. We have a really, really bad set of behaviors. We tend to want to guess. We tend to want to be compensated for our focus. We want to be right because that's what rewarded our ancestors. And it makes sense that we carry that into the market because this is, a very high stakes environment for a lot of people. Unfortunately, our modern brains haven't kind of adapted. We're still pretty primitive in that sense. Our brain doesn't necessarily understand the value of the red and green candles or the line that we're seeing on the chart, but all the same emotions and all the same triggers are still there. So we have to find ways to point those out, structure them into categories, and then, find ways to work around them rather than trying to fight through them, right? Because the number one thing that it all boils down to is stress and impulse, right? Again, every time we get stressed, whether it's good or bad, right? Because there's still a such thing as good stress. And I think that's what really hurts a lot of people. All stress is stored in the brain as a charge, right? And then we just look for ways to eradicate that stress. We need a way to discharge it. And the best way that we know is the best way that's worked for us so far as humans. And that's through violence or taking action. So in the market, it might be, placing an order. It might be, yelling at someone if you're in an argument or in a stressful environment, we develop a certain set of responses to those stresses. If it's good stress, the happy stress that we all experience when we have a big win, that impulse control goes away too. It's the same thing. It's just Boolean. You either have stress or you don't. That might result in impulse trades and wanting to kind of double our winnings and things like that, because our brain also stores those wins separately from the way it stores the losses. So we have to be very careful about things like riding the high and wanting to, play with house money, which is a false concept. There's no such thing as false money or house money. I'm sorry. If you win something in the stock market, that's not you, quote unquote, winning something. It's you earned it. You put in the time, you showed up. You need to view it as your money, because as soon as you sell and you make that money yours, you have the choice whether or not you give it back to the market. And you don't have to expose it to risk if you don't want to. But what do? Right? Oh, I'll just take my initial investment back and I'll throw the rest in, right? At that point, all you've done is, if you lose that second amount of money, you have the same amount that you started with, but you've wasted your time, right? And you've incurred tax burdens and things like that. So there's a lot of things you just need to take into consideration when it comes to how you view your money. And that's a huge part of the process. So I don't want to get too hung up on that, because we do have a lot to cover today. But, it's a lot of that obstacle mess that people find themselves in can be kind of avoided for the most part if we just approach the market in a more reasonable way. So rather than trying to view this as a way to, double your income and quit your job and all that stuff within a year, it makes more sense and it's more achievable to view this as a glorified savings account, right? If you can make 2% a year in the market, you've outperformed what a savings account would normally get you, right? And very little time invest, okay? If you can make 4 or 5% in a year, right? You don't have to make millions of dollars to outperform things that most people already have their money just sitting in and losing to inflation, right? If you can make 4 or 5%, you've probably beat a lot of 401ks, right? 7, 8%. That's probably the highest competitive 401k yield I think you're going to find. So if you can make 7 to 8% a year, you're doing very well in the market. If you can make any profit in the market over the course of a year, you're already beating 90% of the market. You're beating 90% of traders, because they won't be here a year from now. If somebody starts today, if you guys watch this stream and start and you're like, oh yes, I'm motivated now, I'm going to close the stream and I'm going to go figure it out. You're not going to be here a year from now. If you're one of the if you're, if you're not the 1 out of 10 that makes it, right? Just statistically. Okay. So we're here to ramp that up and, improve those odds and improve the value of your financial life, right? So let me also just I have to keep the YouTube chat open here. I want to keep it open on the other window, just so I don't miss anything. So how do we do that, right? We need specifics. So when it comes to the market, we have a role, okay? And it's not to control the price action. And that's where people mess themselves up. They say, okay, I have an indicator. I've got a strategy that I saw on YouTube, whether it's any of my stuff, any other YouTube streamer out there, it doesn't matter, right? You can trade double bottoms for a living, like the guy on the trading channel, Steve, I think his name is. He's going to do it completely differently than the way you do it in real time when you're alone in that room looking at your tickers on your time frames with your money. So you can't copy anybody else and expect to be successful. And that's why, copy trading is unethical as hell. I don't support that. I don't believe in it. I don't believe in unicorn strategies. It just doesn't work. All those do is just give you more complicated steps to follow so they can blame you when you do it wrong, right? What I do believe in is common sense stuff, things that make sense and things that I can do for myself and you can do for yourself. I got my buddy Dave in the YouTube chat saying, you can do it. Tell him, Steve, I believe David can do it. I've taught a lot of this stuff to the Rags to Riches team members. They're doing it. And once they realize that they can do it and they have the confidence and things start to click, they back off, right? Because they realize they've been putting so much time, so much effort, so much focus, and so much money into the market trying to do all these complicated things and trying to make things super serious and aggressive, and it hurts them, right? And that's, I think, where a lot of people end up within the first, month or two, is they just get that bitter taste in their mouth. They're like, okay, I need to slow down, but they don't. They speed up and they hurt themselves. So I think most traders start off with the right mindset. They say, okay, the market is risky, right? So I'll put a little bit of money in and see what happens. All right. And that turns into big money. And I'm going to start dumping paycheck after paycheck in there. And if you explain that to any non-trader out there, they're going to be very confused and be like, well, how the hell did you end up there? Like, at that point, they start considering the addiction route. And you're like, okay, well, you have a gambling problem at that point, right? If you're sacrificing your financial stability and just putting more money into this stuff, and you're losing over and over and over again, when something that you initially admitted was risky, you're probably taking the wrong path, right? Especially if it's not working for you. If it's working, that's a different obstacle. You're kind of being rewarded for taking high risks. And chances are you're not doing that with any kind of consistent plan, right? You're probably just getting a couple big hits and it just hasn't destroyed you yet. And that's okay. But that kind of problem, if it goes untreated or if it doesn't have attention, that's the kind of thing that will destroy you later on. So the goal for this stream today is to teach you guys about portfolio management, position management, and technical analysis, so you can combine all three of those in a way that makes it much more mechanical and systematic. Okay, so let's get into portfolio management. All right, so when people first put money into a portfolio, knowing that the market is risky, what do? They typically buy one share of something just to see what happens, right? So, if it goes up, a couple percent. If it goes up 3%, I'll sell it, be happy with my profit, right? That's all people are really interested in, is just to see if they can do it, right? And at that point, you got two outcomes, right? So you've already started your path at that first decision, right? You're either going to get a profit, you're going to be happy with that, and you're also going to be unhappy with that. You're going to want more, or you're going to get bored or take a loss or see a big red number, and you're going to try to take another trade, right? And that's where that cycle starts, right? You're conditioning your brain to want more. You want more. You want more in both directions. You just don't realize it, right? If it goes up, you want more profits. If it goes down, you want more trades. You want more opportunities, right? And that's where we start fueling things, right? And without a plan, all we're doing is we're taking a big clunky machine that's got a whole bunch of inefficient moving parts, and it's throwing flames out the side. We're just dumping fuel on it at that point, right? We're not going to make money. We're not going to be successful. That machine isn't going to be very smooth if we keep doing that, right? The parts are going to get destroyed. And that's all we're doing, is we're going to build our engine today. All right. So there's a couple different approaches you can take when it comes to portfolio management, but only one really matters. Okay. Yes, Snowflake, it's your personal intervention. We're all here. We all care about you. So when it comes to portfolio management, the only thing that really matters is that you protect your money, right? That's our job, is to control risks, to manage losses, and to keep our money as intact as possible, while also sending it out to go get more money for us, right? If you're not doing both of those things, that's okay, right? You just need to identify that. So if you're not protecting your money, you're gambling, right? If you don't have any insight into why you're losing so much, or any specific plan to mitigate that, you're just a gambler, and it sucks. I know you're going to hate hearing that, but it is what it is, right? And that's the only way you're going to get better, is if you call stuff out. So I used to do it. That's why I can say it. I was probably worse than any of you guys, because I blew up 80% of my life savings within a month, the first month I started. So when it comes to managing your portfolio, this is the top level of risk management, aside from psychology and controlling the actions we take and stuff like that. That's obviously going to be much higher. But as far as portfolio management goes, this kind of dictates how you treat your portfolio. So in the Rags to Riches team, what we like to do is we like to make consistent contributions, just every week, every month, whatever we can, obviously without being broke, right? Because you don't want to sacrifice your financial stability for this. Stock market should always come last. You don't want to be a slave to this, because it'll destroy you. But we like to make consistent contributions, and then we like to allocate a bigger portion of those contributions towards investments and passive growth and things that'll just sit in the background and make money, that are stable. We don't want to risk all that stuff on the ups and downs of the short-term market, right? So I personally use 70%. Some of the members use 80%. Some of them use up to 90%, because they don't want to put too much risk in the noise, right? And then we take whatever's left, and we can choose to either hold that as cash, or we can use it for speculation, which is where you're looking at charts and, looking at trends and support levels and things like that, and placing, positions on short term, this will go up or down, right? That's speculation. Investment is where you look at the company, you say, okay, this is how much money they have. This is their business model. These are the partnerships they have. This is kind of the timeline of their next upcoming catalysts. I'll place some here, I'll place some here, and I'll trade this into where it belongs, right? You're looking at the company valuation at that point. So that in most cases is where you're going to want most of your money, especially in the realm of dividend stocks, because they grow and they reward shareholders and stuff, but that's not necessary. But what's important here is that imbalance, right? We want most of our stuff in the stable stuff, and we want less of our stuff exposed to risk or higher risk, right? So that already is one of the key concepts, is that we're taking most of our money and exposing it to low risk. And we're taking small pieces or low amounts of money and exposing those to higher risk, right? So there's already a fulcrum in play here, right? And we want to leverage that as much as possible. So we're moving the middle of that seesaw in our favor, okay? And that alone will keep us protected from just the stuff we do as new traders, right? Everybody has a degen aspect at some point. We take a bigger risk. We compromise a stop loss. We end up with a big red number in our portfolio and we don't know what to do. It sucks. It's going to happen. So to mitigate that right off the bat, you can just keep a bunch of your money off to the side in stable stuff. All right. It's not going to be flashy. It's not going to make you millions of dollars, but it's nice. Okay. And that should be the bedrock. That's the foundation. That's the scaffolding that builds up and up and up. And, you take those profits and you take the profits from the speculation and you reinvest them into the bigger stuff, right? The more stable stuff, and that compound growth kicks in. And it's very nice over the course of, a decade, 2 decades, 3 decades, a lifetime, your kid's lifetime. Like, that's how big successful families get big and successful. It's not trade and SPY 0 days, right? And for those who aren't familiar with SPY 0 days, those are just high risk contracts where people, you can make big returns and you can also lose all your portfolio. So it's very, very risky stuff. And I just want to point out that there's not a single billionaire alive today that just got lucky, right? It's all very methodical. It's very planned out. It's very, it's all mechanical, and every single one of them is the result of passive income, right? So I don't want to see anybody in here trying to be the first one to figure it out, because it's not going to work. As much as I believe in you guys, I don't want to see you get hurt trying to figure out what just can't be done, right? It's okay. Plus, there's a better, more achievable way. So I just really want to stress the importance of just building in passive income, stable growth, and letting compound reinvestment do the work for you. Okay. So there are a couple different ways you can view an actual portfolio, right? And some people like to have multiple portfolios. Some people like to keep their money segregated. So you can have all your investments and stuff in something like an IRA, so you don't have the tax burden and all that good stuff. If you don't plan on seeing that money for a while, you can just stash and stash and stash. And at that point, if you've got compound reinvestment and you've got, passive growth and you've got dividend payments, dividends can get roughly 12 to 20% per year. And that's already 4 to 5, plus times what a 401k would get. So you've already beat it and you haven't really done anything, right? And if you're someone that doesn't really want to look at charts or companies and blah, 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 and you've got a minimum number of dollars in a portfolio and it's just sitting there in the broker, you can also collect 5% a year. Some brokers like Webull and Robinhood, they offer broker interest. So they just pay you to have settled cash in their account. And that's because they use your money for other stuff. But the goal for them is just to have as much money sitting aside as possible so that they can do the things that I'm teaching you today that don't have that same amount of risk as just trying to gamble, right? Because that's not what they're doing. And that's, 5% a year minus fees. Obviously, there's a little subscription fee. So if you have like $1,200 or more and you just stash it in an account, you'll probably beat your bank account. You beat your savings account for the year, right? It's going to take a little bit to build up to $1,200 if you're only able to save like $10 a week, but that's $10 a week you weren't saving before, right? So it's very, very important to prioritize preservation of capital, right? And I hate the fact that everybody calls it capital, because if you're on a smaller account, it's just like, treat it like a savings, right? You can call it your savings. You don't have to call it capital. You're not a big firm. I'm not, right? I don't even like calling it capital. I call it capital because it's a financial term, but it kind of sets the wrong mindset, I believe. So if you want to call your capital, you want to call it your money, you want to call it your savings, you want to call it your account value, whatever you want to call it, even if you want to just call it capital, that's okay. But just understand that little things like that do make a difference when it comes to our mindset. And that's why we're here, right? So when it comes to managing a portfolio, if you've got the bulk of your stuff in passive income, compound reinvestment, all that good stuff, where it's just growing, and you've got a short-term, smaller view on a portion of that, the smaller short-term portion of that should outperform the big stuff every day, right? Doesn't mean you have to make it that way. But I know a lot of people are concerned about stashing big amounts of money in the passive stuff because they don't feel like they're going to get good returns. But, if you use like a 70%, 30% split, there's no reason why you can't outperform that 70% passive income with that 30%. But if you get completely destroyed on that 30%, you still have that 70% there to grow, and it'll still continue building up and still continue escalating exponentially as the compound reinvestment and all that good stuff kicks in, right? They say, was it Einstein said compound growth is the eighth wonder of the world? And it is. It's just a really cool thing that we can use and we can leverage and all that good stuff. So, all right. So what we typically like to do when we teach new traders how to manage a portfolio is to take the portfolio amount, right? However much you have in your portfolio. If you got $1,000, that would be the amount, right? Or, if you want to put 50,000 or 80,000 in an IRA, obviously you can't do that all at once, but that would be the amount. And then what we like to do is take that and split it up into groups of 10. So 10% blocks, basically. All right. So if you've got 10% blocks, you've got 100% of your amount, you can then allocate each of those 10% blocks to a specific purpose, right? So if we're using like a 70%, 30% split, that means we can take 7 of those blocks and put them over into the investment side. We can take 3 of those blocks and put them over onto the speculation side, okay? And then within those, right, in those 2 categories, we can then take numbers of those blocks and dedicate them to specific things. So for example, if I want to buy VOO, that's a Vanguard ETF. It's a very stable growth ETF that pays a nice dividend. It's pretty expensive, but I might take 2 of my 7 blocks, 2 of my 7 out of the investment side, and I might, I might buy some VOO, some Vanguard, right? And then to offset that, right, since it's slow, what I can do is buy a high risk, high yield ETF on one of the 10% blocks, and I can balance that against the stability of that Vanguard ETF. And I'm getting a little bit complicated here, so this is mostly for people who are already kind of in the loop a little bit. I could buy a high risk, high yield ETF and offset that, because that high risk, high yield ETF will provide a much more aggressive dividend return throughout the year, which is a capital gain. So every time I collect a dividend payment, I have to pay taxes on that, or I have to be aware of that, right? Because at the end of the year, the IRS wants to know what we're doing, and it loves when we're successful. So what I need to do is pair those by purpose, all right? So if I've got a stable ETF that's twice the size of a high risk, high yield ETF, and the small one is paying me aggressive dividend payments, but I want to keep all my high risk, all my Vanguard stuff, my stable stuff, I don't want to sell those shares. I want to hold them long term. And I want to make sure that those dividends become qualified. So again, we'll circle back to all that stuff. But basically, it just means that I want the lowest possible tax burden on what I have. Okay. So that the job of that little guy is to provide aggressive returns and also act as a shield when it's time to sell stuff at the end of the year. So you have to pay taxes on stuff, the money that you make, profits, dividend payments, stuff like that. But you can also offset those with capital losses. So this is more of a tax area of things, which we teach. So don't, if you don't understand it all, it's okay. But when you lose money in the market, you can also claim that as a deduction against those profits and the taxes you have to pay on those profits. So that's the job of that little guy, right? So if I want to build a long-term stable position, I need to be aware of things like that so that I can put all the right things in the right places and make that money, more efficient. Okay. But you don't have to do that. Like if you're a brand new trader, that alone is a very complicated concept. And I don't want anyone to freak out and think they can't do this stuff because of that. I just want you to understand the importance of knowing all the things that you don't know and the fact that this is a continual learning process. Because what you don't want to do at the end of the year, if you've got a low yield, but very, very stable, costly investment, you don't want to have to sell those shares off at the end of the year just because you made too much money elsewhere, right? Because and plus that ETF is probably going to be in a profit territory. It's probably not going to be for a loss, right? So you're just going to have taxes and taxes and taxes that you have to pay and nothing to offset them because you didn't understand how, capital gains and capital losses tax work. So it's very important to trade what you know, study what you don't, and take very deliberate, specific steps to achieve a very specific and deliberate goal. Okay, so a year from now, right? And we're just going to loop back to the psychology. Sorry, I have a denture, so it's kind of flopping around as I talk. A year from now, where do you want to be? Do you want to focus on the market? Do you want to just have another savings account that's a little bit more efficient than your bank? Do you want to get out of your 401k? Do you want to have a little extra free time? Do you not want to worry about paying Netflix every month? Do you want to have a little bit of extra gas to get back and forth? Do you want to go somewhere once a year on the weekend? Do you want to try to buy a Lambo, go for broke if you don't make it, whatever? Not everybody has the same goals, right? So a year from now, where would you like to be? Where would you like to be 5 years from now? Where would you like to be 10 years from now? What kind of money would you like to be making? What do you do for a living? Do you like your job right now, or does it just pay the bills? Do you hate your job? Do you hate the people you work with and want to start your own company in the same industry? Like, those are the questions that we kind of just need to ask ourselves at some point to kind of figure out where we are in life and take that inventory. So if you answered anything, and this is all rhetorical, so don't answer me, just answer to yourself. A year from now, if you said anything other than, not in the market, basically, right? This event is not for you, like this webinar, right? If you just want to gamble and have a 50-50, which is less than 50% chance of just making it big, and you think you can do that consistently and you can make all these huge returns and you can do that 5 years in a row, great. I hope you do. I hope you figure it out. But if you don't plan to be in the market a year from now and you don't have specific things in place to make that happen, I won't see you a year from now. And I want to make sure that you guys are all here, and I want to make sure that you guys are all set up for your goals, right? I don't know enough about each of you personally, to kind of help you outside the market, but I can help you in the market. That's what I do, right? And we're not here to trade for the sake of becoming traders. We're here to trade for the sake of buying ourselves free time for other opportunities in life, right? The market comes last. This is not the job. You don't want to just replace your job that you're doing now with trading all day, because that's not good for your mindset. It's not good for your life either. So we do this through specifics, right? So we're going to help you build a plan. So if you view your portfolio as a glorified savings account and you break it up into 10% blocks, and you can manage you can compartmentalize your risk, right? That's what we're doing here. We're just taking each risk, each loss, and we're, putting it in its own little bucket, so that think of it like a little grenade in a box, right? We've got 10 little boxes. All of them are armor proof. One of our positions is a grenade. Okay. Do we want that grenade to destroy everything, or do we want to put them all in their little boxes so that that one that blows up doesn't destroy the other 9, right? That's why we want to manage our portfolio. And we'll circle back to the portfolio stuff, but I just want to stress the importance of, hey, what's up, Porter? I just want to stress the importance of having some awareness when it comes to your money, right? And if you don't feel like you can make 1% in the market, 2% in the market, 5% in the market, 12 to 20% in the market, there's nothing wrong with just putting that money in a savings account. Just hang on to it. It's okay. There's a lot of concern about, inflation outperforming, savings yields and all that, which is true, but it's better than losing your life savings in the market trying to figure it out, right? You can always paper trade. And for those who aren't familiar with that, it's just practice. It's practice trading on a practice account. People don't like to do it because they're not making real profits. And we just want to, again, our brain wants to be compensated for our effort and time. But when you, quote unquote, need skin in the game, you're actually working against yourself, because you're not only getting the expertise, the experience and all that good stuff, but you're kind of putting undue stress on yourself, and you're losing money. So it's a self-feeding cycle. And that's where, just taking a step back and practicing might be beneficial. Right. So then we got to talk about position management. Okay. There's a couple different strategies, and this is what I want to teach you guys specifically today, because I know we harp 90% of the day on psychology and portfolio management, or at least I do. So I want to teach you guys some position management stuff. And a lot of people, when they realize they can break up their portfolio into smaller amounts, and then they can take each of those 10% blocks and break those up into even smaller buys if they want to. Like let's look at a stock really quick, right? If you wanted to buy this one, American Airlines, if you wanted to buy some right here, okay, most people when they start trading, this is what they'd see, right? They say, oh, we're coming back. We could get rid of the moving average and all that good stuff. So just looking at these shapes and colors, right? Somebody would say, okay, I like American Airlines here. A buddy at work told me to buy it, whatever, right? I saw it on a YouTube video. I saw it on X, whatever. So, okay, I'm going to buy it right here. 1451, right? It goes down. Maybe they sell it. Maybe they don't, right? That's where they kind of branch off on their tree. If they had bought and held, they would have lost about 30% of their investment. Okay. And then a lot of people, there's different types of people out there, right? Some people would have loved it. They'd still be holding it. They'd be stressed out potentially, but they'd still be holding it. Some people would have sold immediately as soon as they saw a little bit of red. And that's kind of where you start to learn about yourself. But that's if they put all 100% of their money right here. Okay. Now, what they didn't realize, the same trader, right? They bought it right here. What they didn't realize is that they could have taken that 100% block of money and they could have broken it up into 3 or 4 buys, right? So, sorry. So if I buy some here, right, my average per share for all the shares that I own would be $14.51 per share. Okay, so that's my average or my cost basis. Okay. If I took if I took maybe a quarter of the money that I intended to buy these shares with, and I bought here, my average would still be $14.51, but I'd have 75% of that money sitting aside to buy more shares if I need to, right? And that gives us a little if-then decision tree. And this is one of the earliest forms of logic that a lot of traders learn. So if I bought 25% of my shares here and the price went up, I would just lock profits on those 25% of shares and I would be happy, right? I'd move on to the next trade. If the price went sideways, I would have to fight myself to not take action and buy more shares, right? But ultimately, the plan should dictate that I don't do anything, right? Because I just put more money in the same spot. That's not really managing risk very well. That's just trading because I'm bored, right? However, if the price went down, and this is my average, and then I decided, okay, I'm going to buy some more down here, right, at this level, my average would then be right here. Okay, so I'm taking this average, and if I'm buying more here, all that's going to do is it's going to move my average down here, right? So 25% of the amount that I plan to buy with here, 25% that I'm plan to buy with here, my average lands right in the middle, and I've still got 50% of the cash sitting on the side. Okay, so I'm 50% in, I've got 50% on the side. The price is selling off. The guy who just bought up here is going nuts. He's losing his marbles up here because he's down. And I'm still down, but I'm down about half as much, right? And then, the price drops off even more, right? Let's say I wanted to buy some more down here, okay? I've still got 50% of the cash. So if I wanted to buy some down here, for example, I'm just going to move this down here, right? Let's just say that around here, right? Anywhere in this block. And there's a bunch of different strategies you can use to determine that. Now my average is halfway between this one and that one. So it's down here somewhere, right? Maybe a little higher, I guess. My other lines are in the way. So I picked the wrong ticker. So now I'm still down, but now I'm 100% in. Now I can set a stop loss. Now I can figure out where I want to cut this if it keeps going down. But all I have to do is have the price go up here, right? So I can break even or sell the bulk of my shares back off. So if I bought 25% here, 25% here, 50% here, right? So I'm doubling my buys each time up to a limit, right? I don't want to keep committing more and more money to this. Once I'm in 100%, that's it. I can stop adding money to it because at that point, if it keeps going down and I've taken reasonable measures, I don't want to be in that trade anymore and I can just cut the loss, right? But my average is now down here instead of all the way up here, right? So rather than being down 30%, I'm down maybe, I don't know what that range is here. Let's check it. I guess that would be right here. What's that? 3.52%, right? So rather than being down 30%, I'm down 3.5%. Okay, so that alone, just through position management, right? We haven't looked at any candles yet. We haven't looked at any pricing stuff yet. I haven't looked at support levels or any of that stuff, right? I haven't added any indicators. I'm just spacing the buys far enough apart to matter. And I'm using the right allocations to make sure that there's enough weight and enough leverage over that average to push it down in meaningful ways as I add the same amount of money that most people would have just bought with right here and would be 30% down and struggling, right? So there's a hierarchy here when it comes to risk management. So the first tier is portfolio management. That's how much money you're willing to commit to a position in total, Okay, so in this case, if we just limit those to 10% of our portfolio, we have up to 10 potential grenades, right? Some are going to go up, some are going to go down, but no individual trade will destroy our portfolio if we're just committing 10% to that one trade. Does that make sense? And that's like a good concept where I think it's just kind of implemented poorly for a lot of people, and that's just because they don't know what they don't know. And then underneath that umbrella, within that 10% block, okay, we can then take smaller amounts of that smaller total and break it up into smaller buys, right? So if you think about it, if we're taking 10% of a portfolio and we're using 3 buys of 25, 25, and 50, what we're doing is we're buying with 2.5% of our portfolio, 2.5% of our portfolio, and then a third and final buy of 5% of our portfolio, right? Because that adds up to 10%. So if I'm on a $1,000 account, what's that going to be? It's going to be $25, $25, $50, right? And that adds up to $100, which is 10% of 1,000. Okay, so that's all we're doing. We're just taking our risk and we're putting our dollars in position within that risk at reasonable areas, right? Now, some people like this, some people hate it, some people love it and can't figure it out. Some people hate it and they're just naturals at it. And that's okay. That's, again, it's a very personal journey. You have to figure it out for yourself. Let me check my DM real quick. Sorry, guys. Okay. Sorry, guys. I have to cut this one short. There's been a little bit of a personal situation. I apologize. I will get back to you guys as soon as I can. Let me end the stream here.